Morning, everyone. Welcome to today's Phillip Research Morning Call. I'm Wee Kwang. Today we have quite a lot of counters to cover. I'll be starting off with Banking Monthly. Then we have a series of results and updates, as well as a Q&A dental initiation. And then ending off with SG Weekly. Without further ado, let's begin. Next. Okay, so for Singapore Banking Monthly, for the month of January itself, we do see that the interest rates are holding steady from the fourth quarter, similar to levels observed in the fourth quarter. And next. Okay, so average rates are down about 55 basis points for SIBOR and SOR on average. It translated to about 20 to 30 basis points in NIM compression for the banks over the first 3 quarters. And so what we are expecting in the coming results for the fourth quarter, we are expecting it to be down. It will be similar levels to what was reported in the third quarter. So overall, we are expecting NIMs to come in at about 1.6%, which was maybe about low single digit, lower than the 1.63% that we saw across the banks in the third quarter. And we do note that the banks have continued to manage their funding costs, with OCBC being the latest to cut their rates on their savings deposits at the beginning of January itself. And next. And also, we do want to take note on the introduction of SORA. So SORA is the new the new interest rate benchmark that is supposed to replace SOR and SIBOR. Okay, so if we want to compare directly between SORA and SOR and SIBOR, the main difference is that SOR and SIBOR is actually a forward-looking rate that is actually based partially to USD LIBOR, which is the London Interbank Offer Rate. And so what happened was that previously it was found to be manipulated by US and EU banks, European banks. And moving to a SORA, which is backward looking, what the MAS does is actually they have a list of eligibility to be considered into the SORA. So the SORA is like backwards looking, and every day what the banks do is that they actually submit eligible transactions on loans itself to MAS itself, and they will consolidate the rates so that they can have a backward rate that will be calculated into the SORA itself. So the SORA has actually been calculated over the past, I think, for a very long time already. Just that previously the eligibility to be considered into the SORA index itself was quite high, and now they have lowered the eligibility, and with more SORA loans coming out itself, you can see that the SORA rates will start to stabilize, and it will help to provide more be a better indicator of interest rate moving forward. And for the banks itself, this removes a pricing premium for the banks on the uncertainty that was brought about by the forward-looking SOR and SIBOR. And so moving forward, the banks themselves are expecting a little bit of NIM compression, but however, it is all within calculations. It's all within expectations, sorry. And for consumers, you will be expecting more stable interest rates because they're all backward looking. Yeah. Next. So if you can take a look at the graph on the left-hand side again, if you take a look at what's the main difference between SOR and the problems that SORA is supposed to fix when it comes to SOR and SIBOR is that we see that in 2015, actually interest rates, which are the light blue and dark blue lines, they actually moved ahead of the interest rates when the interest rates have not risen yet. So that was in anticipation of a forward-looking interest rate hike then, but it did not happen until much later, 1 or 2 years later. So this is what was the main manipulation by the US and EU banks. Next. And what happens is in this year itself, SORA will be moving to phase out SOR entirely, which is more the swap offer rate, which is more targeted at business loans. And then by 2024, SIBOR itself will be removed as well to only include, so the Singapore interest rates will all be based on SORA. And we see that the banks have already started to come up with more products that are based on, they are supposed to replace SOR loans. And Yep. However, like I said again, the SORA transition, although there will be some NIM compression, but because of the repricing that we see by the banks itself, it will just offset each other for the year of 2021 itself. Next. Okay, when it comes to loans, we saw that loans actually improve month on month in December. However, year on year, it is still down. Next. So for local loans, it actually fell 1.98% year on year, but this is an improvement from the 2.32% decline in November itself. And for the gainers, year on year, we see that business services grew 5.7%, and building and construction actually grew 5.3%. For the losers, in general commerce loans actually fell 10.5%, and credit card loans fell 13.5%. So these are the largest movers year on year. Next. Okay, so for the for the loans month on month, we saw that this is the second consecutive month of growth for both, which is heartening to see. So meaning we are starting to see the uptick from economic activity to flow down to loans already. So this is something that's good. And both business and consumer loans actually chalked up gains. So actually grew month on month as well. For the gainers, we see financial institutions having a 4.9% gain month on month, and credit card loans actually picked up 1.7% month on month. Next. And something something more importantly to take note of is that housing loans actually grew 0.4% month on month and 0.3% year on year. So this goes to show that actually housing, there is a huge demand for housing loans, and this will provide a runway for loan growth over the next 3 to 4 years as we start to see, the completion of more and more real estate projects in the coming years. Next. And in terms of market activity, we saw that actually the both derivative and securities volumes and value itself have kind of normalized at a higher level. First of all, we saw that for security side, it actually grew about 20% year on year in January, which is similar to what was observed in the first half of 2021 levels, which is between July to December for SGX itself. And for top 5 equity index futures contracts, the turnover was also up 4.4%, comparable to the DDAV turnover of 4% in the first half of 2021. However, of course, based on the result that they released, SGX actually reported a fee per contract to fall by a little bit due to the fee holiday that was implemented when they shifted from their MSCI contracts to their FTSE contracts, especially for the Taiwan index futures. However, moving forward, because the transition has already been done, this fee holiday will be lifted, and it will help to improve margins for SGX itself. Next. And so we see that actually for SGX, a lot of the sustained market participation from retail investors will be what will really boosting their volumes and margins, both volumes and margin moving forward. You can see that actually the security side actually kind of grew more, which was against what was the backdrop over the past few years. Because the past few years, SGX have been growing their derivatives products more. However, this year, the past 1 year was what we saw that the return of interest of the retail investors. Next. So in terms of recommendation, we are still maintaining a neutral stance on the sector, and we prefer SGX on their latest results. We see that they have stable earnings, and we also noted that there was growth, positive growth contributed by the newly acquired businesses, which will provide for more runway of growth moving ahead. And the bank's earnings will still be heavily dependent on fee income in financial year 2021, and they will be releasing their financial year 2020 results over the course of the next month, the upcoming month. Yeah. And that's it from me. I'll now hand the time over to Natalie for Ascott results.
Thank you, Wee Kwang. So now we'll go into Ascott's full financial year 2020 results. Next slide, please. So for the results on the table, we see that gross revenue actually fell by 28% year on year. This was due to lower revenue from COVID-19 and the leases renewed on variable terms. Also, there was a decrease in contributions from the divestment of Somerset Westlake Hanoi and Somerset Liang Court. And this was partially offset by the acquisition of the Ascendas Hospitality Trust portfolio, which started contributing in January of 2020, as well as acquisition of Macquarie Park Sydney and Citizens Connect Sydney Airport. So we'll flow right down to the DPS line. So DPS was down by 60% year on year. And the Ascott declared a dividend of 3.03 cents. This distribution included capital distributions from divestment gains, which contributed about 48% of DPU. Okay, so just to note that this 3.03 cents of DPU was below our expectation. It came in at 75% of our forecast. So now we move on to the positives. On the positive side, Ascott was able to divest 4 of their assets at above book valuations despite COVID-19. So some of these deals were actually negotiated before COVID hit. And the good thing is that none of these deals were repriced, meaning they maintained their pre-COVID valuations. As such, some of these assets were divested at around 52 to 69% above book. Okay, the second positive, of course, is the balance sheet remains robust, and the borrowing cost actually fell from 2.3% to 1.8%. Cash on hand is also still robust, almost 500 million in cash, and that will be able to cover 3 years worth of operational costs. Not to mention there's still 200 million left in divestment proceeds to be deployed. So this divestment proceeds can be used, as we saw in 2020 and 2019, to shore up DPU, especially when there are divestments that will affect the MPI. Next slide, please. On to the negatives. So this is unavoidable. The second half FY20 DPU as well as the full year the second half RevPAR and as well as the full year RevPAR was down by 69% and 61% respectively year on year. And so 7 of Ascott's key markets was actually down by about 56 to 86% in the second half. And the only country or geography that was sort of better off was China, which was still down by about 27% year on year. In 4Q, we actually saw that domestic travel did, in 3Q, domestic travel actually did rebound. However, due to the resurgence of COVID-19, in several of the key geographies like China, France, Japan, US, and Vietnam, this domestic travel actually sort of fizzled out in the fourth quarter. Portfolio valuations fell by 7%, and this was because valuers factored in a weaker performance due to COVID-19, as well as higher cap rates and discount rates. So according to the WTO, World Tourism Organization, the recovery to 2019 levels will take about 2.5 to 4 years. Yeah, and that will affect the valuations. But I think the point to note here is that Ascott still managed to deliver several divestments at above book value, which indicates that while the road to recovery is long, its well-located assets are still well sought after. Ascott also gave out about $18 million in rental rebates. These were mainly to Australia and France leases. However, ART also benefited from about 17.3 million in wage subsidies from various governments in the markets which they operate in. What else is new in this update? Of course, is the proposed acquisition of the purpose-built student accommodation, PBSA for short, asset in Atlanta, USA. So this asset is actually located near University of Georgia. Georgia Institute of Technology, Georgia Tech for short, in Atlanta. Basically, we think that this acquisition is a good acquisition because if you recall earlier in the year, Ascott actually had several of their master leases as well as the management contracts with minimum guaranteed income, MCMGI for short, that were renewed on variable terms, either as management contracts or with lower fixed rents as well as a variable rent portion. So that actually will reduce the quantum of stable revenue sources, and so Ascott will need to find a way to shore up this stable revenue portion. So one way of doing that is to look at long stay accommodation classes. So the long stay accommodation classes include the rental housing, which Ascott currently has in Japan, as well as other long stay kind of accommodation types like PBSAs. So for this PBSA, is located in the US, where 90% of the university students are actually domestic US citizens, and they might come from other states. So the occupancy throughout the year, even during COVID, was above 90%. And the average length of stay is more than 1 year. So for this PBSA actually services Georgia Tech because it is in the closest proximity to Georgia Tech, and Georgia Tech actually requires their year 2 and year 3 students to actually live on campus or near campus. Okay, so the pro forma DPU accretion is about 4.4%. So we factor that all into our revenue. And DDM base target price was raised from $1.15 to $1.17. Also because we roll forward our estimates to the FY21 earnings forecast. Okay. Next slide. We're moving on now to Ascendas REIT. So this is Ascendas REIT's full year 2020 results. Next slide, please. Okay. So we start off with the revenue. Revenue grew by 13.6%. This was due to several acquisitions, namely the 28 US and the 2 Singapore business park properties that were acquired in December 2019. So this would be the full year contribution from these assets, as well as the contribution from 2 San Francisco offices that were acquired end of last year, November 2020. There was also contribution from the completion of one of their assets under development, which was in Australia, and the revenue was lower because of some almost $18 million in out-of-pocket rental rebates. Okay, so we'll just move right through. DPU, as you can see, was down by about 6.1%. This was due to the enlarged unit base from the EFR that was conducted in November and December of 2020. So the share base was increased by some 10%. This was, if you recall, it was a $1.2 billion equity fundraising done by preferential as well as private placement, and it was primarily to fund several acquisitions. The first one was the two offices in San Francisco, which has been completed. Second one would be an suburban office asset in Australia, which also has been completed, and the last one outstanding would be the portfolio of Europe data centers. Yeah, so this is still under negotiation. It is, according to management, it is still within the timeline. It has yet to contribute to the portfolio, and that will sort of put a drag on earnings in the meantime, as the earnings has not increased yet, but the share base has. Okay, so moving on to the positives for AREIT. Portfolio occupancy is stable at 91.7%. Year on year, actually increased by 0.8 percentage points, which is very small, but nonetheless an increase. This was due to, or rather aided by, the portfolio occupancy in Singapore, lifted by the logistics sector. So some of the new demand that came for Singapore was from the government agencies, logistics, supply chains, biomedical and agri and aquaculture sectors. Reversions were positive in the green at 3.8%. This was due to better leasing for the Singapore portfolio during the first half of 2020. Although I must also qualify this by saying that in the third quarter and the fourth quarter, AREIT's Singapore portfolio did have some negative rental reversions. This positive reversions for the portfolio was also due to strong reversions in US and Australia. So the reversions were about 16.7% and 14% for these two geographies. Okay. The last positive would be that gearing improved from 35.1% to 32.8%, and this was partially due to, or rather enlarged due to, the EFR that was mentioned in 4Q 2020. Moving on to the negatives, there were a handful of non-renewals for AREIT during the year. Some of the assets that ended the year at zero occupancy was 9,000 square feet logistic asset at Changi North, as well as a 15,000 square meter industrial asset at Joo Koon Circle. So these two properties, they actually had non-renewals. There was another non-renewal at Syntec 2, which is a Science Park asset in the Jurong area. So the occupancy fell to 0% at 3Q. However, in 4Q, AREIT was able to fully lease out this building to a government agency. So in terms of pre-terminations expected, as well as the impact from the realignment framework, very, very minimal impact from expected. So the management actually estimates that the impact should be minimal at 0.1% of GRI. So that basically sums up our update for Ascendas REIT. In terms of target price, raised slightly from 3.61 to 3.73 cents dollars. Sorry, and yeah, sorry. One last thing to note is that for some of the construction costs, this is an update on the sector in general. So construction costs have sort of ticked up a little bit. This is due to the manpower as well as the compliance with the COVID safety measures, etc. So in terms of most of the capex or development projects have already been locked in. However, there will be a slight increase, 2 to 3% for pre-existing contracts. So for context, the management guesses that if these contracts were brand new contracts, the cost would have been about 15 to 20% higher. So thankfully, these contracts are already locked in, and the marginal increase in cost would be about 2 to 3%. Okay, so we reiterate our buy call, and as mentioned, target price is $3.73. Okay, I'll move on to Jie Hui. Thank you.
Okay, thanks, Ned. Yeah, I'll be going through an update on Myanmar's political situation as well as its impact on Yoma's businesses. So, yeah, just a brief background on what has transpired over the past week. Yeah, Myanmar has held its general election in November last year, and the NLD, National League for Democracy, which is led by Myanmar's leader Aung San Suu Kyi, made a landslide victory. But last Monday, but along the way, Myanmar's military alleged discrepancies in the votes, and last Monday, the military replaced elected ministers and announced the holding of power under a state of emergency for 12 months. So on the day itself, the people of Myanmar experienced telecom disconnect, construction paused, and restaurants were quiet. As of 3rd Feb, most were back operational except for large-scale construction. But over the weekend, street protests were actually held, and Myanmar experienced a second round of internet shutdown. As of today, internet connections were partially restored. Yeah, so just to provide you some color. And then regarding its impact to Yoma's businesses, you may see business disruptions in the near term, while COVID-19 brings its own set of challenges. For Wave Money, we are expecting fewer OTC over-the-counter and digital transactions through Wave Money, as consumers may conserve more cash. F&B sales are also likely to be weaker due to lackluster consumer sentiment. And given the pause in construction for Yoma Central, we believe that the completion may be delayed by a quarter till 3rd quarter of 2022. In addition, ahead of 1Q21 update, we also revised our FY21 top line to account for the lockdowns that took place from October to December, as well as lowered growth forecasts for the next 2 years. Therefore, as a whole, FY21 and 22 earnings have been cut by 27% and 35% respectively. That said, international lenders and investors are still supportive for Yoma. As of date, nobody has called to pull out their funds. And just a quick update on Yoma's ongoing deals. We believe that Ayala will still proceed with its second tranche 46 million equity investment in the company by 11 May 2021. Ends Financial's transaction in Wave Money is also close to completion. And Yoma's deal to buy out Telenor in Wave Money is still live as funders are still out there. Going forward, Yoma will be more conservative cash. So our recommendation is mainly due to, as in, we maintain a buy rating with a lower target price of 34 cents from 46 cents, mainly due to, firstly, our valuation is largely hinged on asset value. So if you can see from the valuation table on your right, Yoma Land's valuation is actually making up about 70% of Yoma's total assets. So yeah, as mentioned, this whole valuation method is based on asset values, mainly based on the asset values. Yeah, and then secondly, as mentioned, international lenders and investors are still supportive for now. So should investments into Yoma remain intact, we believe that it's more likely that Yoma will be able to tide through this crisis during this period of time. So yeah, going forward, we will keep a close watch on this counter and keep you posted on any further updates. Yeah, this is all from me. Now I'll move on to Terence for BRC.
Thanks, Jie-Hui, and good morning, everyone. We attended BRC Asia's results briefing last week, where they reported first quarter financial year 21 results. Do take note that this is part of our Phillip on the ground coverage, and we have no rating on the company. For first quarter financial year 21 results, we've provided a summary, the financial summary on the table on the left-hand side. You can see that revenue declined 6% year-on-year to 213.4 million due to COVID-19 related disruptions to the local construction industry. We do think that it's better to compare on a quarter-on-quarter basis, since a year-on-year basis will definitely show a decline in revenue. So you can see that on a quarter-on-quarter basis, revenue actually increased 82%, which really shows the improvement in the construction industry post circuit breaker. Despite the slight decrease in revenue, though, there was a onerous contracts impairment recognized by the group due to the sharp increase in global steel prices. That is why you see operating profit actually down 23%, and this actually followed all the way to the net profit. As a whole, BRC Asia's management are optimistic on the outlook on the recovery of the general economic activity with phase 3 of Singapore's reopening, and also a national effort to vaccinate the whole entire Singapore population, which should bode well for the construction industry. So that's all from me. I'll pass on my time to Paul. Over to you, Paul.
Okay, thanks, Terence. We will start off with our Q&A initiation, the report we issued this morning. Anyway, as the title suggests, record earnings expected. So we think it will be a record year for them, the next upcoming 1 to 2 years. Next slide, thanks. Okay, a bit of background, in case some may not know, but Q&M Dental is a 25-year-old brand. I think it's a dental clinic chain since 1996, and it was listed, almost 10 years, I guess. So at present, they have about 100 plus clinics, most of it in Singapore, about 80, then in Malaysia, China just one. And we did a rough estimate. They have probably about 10% share in terms of the dental, at least 10% share of the private dental clinics in Singapore. We're just taking the number of clinics, but if you take revenue, because of the higher number of specialists, it should be higher, but we don't have any precise number on that. The other thing to note for Q&M Dental is they do have a listed associate, which is the Housing. So if you look at the picture on the bottom, below the Singapore map, so Housing has about 10 dental clinics and 6 dental hospitals in China. They call it dental hospitals because it's almost like one whole building on its own. We'll explain later, mainly in Liaoning. The picture on the left is just, this is one of their largest chain dental clinics in City Square. Next slide. Okay, in terms of the revenue model, no pictures here, but basically what they do is, as usual, just the clinical consultation, everything you pay when we visit a dentist. In terms of customers, no dental services, like all medical services, you cannot advertise in Singapore. So as a result, you have to rely on walk-ins and referrals, but about 80% plus is all private. And the balance 20 is maybe like corporates and government. But you can refer more to the report. In terms of geographical split, I think 90% of it still comes from Singapore and the balance from Malaysia. The important part is probably the dentist compensation. So for the Q&M dentists, they're not paid a fixed salary. So it's all commission based, basically a share of the gross profits. And the share of the gross profits is 40 to 50%, depending on the seniority. On the last bullet point, the margins is huge because I guess you're basically selling a service, a procedure. So the key point for us here is that you can only get big margins in general for healthcare is if you are doing procedures. So I mean, if you are just if you are a GP clinic, then you will be more into like dispensing medicine. Whereas if you are doing procedures, then you tend to get higher services content. Obviously, the margins will be better. And the thing about dentistry is that, I mean, we all know there's no self-medicating alternatives. Okay, next slide. Okay, in terms of our investment thesis, that they're basically just there are two key investment theses. So the first thing is that we think there's going to be a resurgence in organic growth. If you just look at the chart, if you look at 2019, you can see there was a big pickup in number of clinics. Prior to that, they were more on inorganic acquisitions. In the report, you can see they acquired quite a number of clinics, but only in 2019, they started to grow organically. And then 2020, they will stumble a bit because I think no choice, you can't really open anything during this pandemic, circuit breaker and so forth. But we think in 2021, 2022, we are looking for quite aggressive growth from them, maybe around 20% growth in clinics per annum. So this will help provide growth organically for the revenue. So this will be the foundation to their growth. And in the table, on the bullet points you see on the right, I mean, that's the question we asked. I mean, why would a dentist want to join QNM? So anyway, these are the typical reasons. I think only with a large a dental chain like QNM, where you can attract walk-ins, which is the core source of income, because you cannot advertise. So the ability to get them by reputation, by location, even prominent logos, displays are all important. So that's why the first bullet point, a dentist will want to come to them because of they can attract the walk-in customers. The second point is that most dentists do not want to. They would rather spend their time procedures, helping and treating patients, rather than doing admin finance. I think this is quite self-explanatory. Better work-life balance, I think not unique to them. I guess everybody wants that. Then the other parts will be the specialist part. That's the second last bullet point. I think if you are a specialist, one way to get referrals is the general practice, the GP dentist can refer the specialist to you, then there will be one source which other than specialists cannot. And as a specialist, you want to be, last bullet point is to focus more on the high-end procedures and less on the general procedures. So under their network, you can see these are some of the benefits you get from joining. The dentists that join them is a combination, can be graduates or even existing dentists that might come over. Next slide. Okay, the other investment thesis is the new growth opportunity in COVID-19 PCR testing. So basically, there are two important timelines here. You can't see the first because I don't want to add too much stuff, but in April 2020, they actually formed a joint venture and into this company called Acumen Diagnostics. So this company has the approval to sell the PCR test kits. So that the picture is there, they call it AQ Corona 2. Then the other key milestone is in September, where this 51 joint venture, they have actually received approval to, by the MMH to actually undertake PCR testing. So it's not as simple as I initially thought, because you are handling COVID, so you're handling a very infectious virus, number one. And number two, because you're doing molecule testing, DNA molecule testing, because that's what PCR does. So PCR, you're testing for the genetic material of the virus. And because of that, there's a higher level of expertise, and also you need, I guess, more expensive equipment. So it's a higher barrier than just a normal, blood or kind of labs that just test blood and so forth. Okay, anyway, the first bullet point in terms of the revenue model. So there are two parts of the revenue for this 51% joint venture. So what they do is they will sell the PCR test kits, and also they will provide lab testing. So the one revenue source is because these test kits are their own proprietary, made in Singapore, although they outsource the production, and also they will also provide lab testing. They were not the ones who will go out to swab maybe the workers in the dorms or any worker. What they do is the authorities will do the swabbing, and then they will just send it to them for the testing and the use of the kits, and that's where they make the money from, these two sources of income. The second bullet point is in terms of how do we, because this is all under NDA, so very hard for us to kind of nail down the numbers, but we're just taking Singapore currently, it's all in the report, but anyway, we're assuming maybe 20,000 PCR tests, 3% market share. Each PCR test is about 200, we're assuming 150, then we add an 25% net margin. So we get an estimate about 4 million earnings contribution from this. This is PetMe because they own a 51% stake. Okay, the notes that you see on the right is essentially, who needs PCR tests? Basically all travelers, but I think the key one will be the fourth bullet point, the RRT. So right now in Singapore, every 14 days, workers in, I think you can see all the sectors, construction, marine, and so forth, they actually need to undergo a PCR test. Singapore's target is 40,000, but I'm not sure they're going to hit that number. But at least for now, we kind of estimate about 20,000. So from that, you get a lot of PCR tests from the authorities sent to their labs and so forth. I think the rest is quite self-explanatory. I think even individuals, you also can get another form of PCR testing from individuals now that maybe they voluntarily want to go to take, or maybe before they pre-departure they need to also take. But I think the details are there for you to see. Next slide. Okay, in terms of the other catalysts, we think there's two more, but I think these are not. This is less tangible for us because it all depends on the circumstance. But in July 20, they did mention that they are working on a 5 million deal to 5 million PCR test kits to Mexico, which is under discussion. We no idea if this is concluded, what's the status now, but if this happens, then you can do the math. Even if you assume a $1 profit, you can even get 5 million earnings from it. But this is obviously not in our numbers, but this will be a nice to have a contract. The other catalyst will be a turnaround in Alcin. So Alcin, as you recall, is their 43% associate. That has been suffering losses in 2019 and even in the first half. First half 20, we can understand because of the COVID, because of the outbreak, they actually had to undergo some temporary closures. They were even temporary closures in December, they announced that. So in our forecast, we're assuming losses for them. But the more important thing for us is that these losses are from upfront costs in expanding, because in China, you either be a big dental clinic or nobody wants to come to your hospital. Because what happens is that they see the large ones as established, and the patients tend to be attracted to the larger hospitals. So as a result, when you do that, you in the near term, you have to suffer a lot of upfront costs because you have to build a large facility, even though there may be only 10% utilization or hardly any customer, but you still have to put up the upfront. And as a result, you will undertake a lot of losses in the near term. So this, like any typical big hospital that is a greenfield hospital. So anyway, just to sum up, the growth drivers that we see is, of course, the organic growth, which will be the foundation of the numbers. And then the second bullet point will be, because of the pandemic, what happened is that a lot of patients cannot travel, and of course, a lot of them are stuck at home. So more patients are, more people are willing to, there'll be more visitations to the clinics because they're all stuck here. And even they're not stuck here because they're working from home, they have more time to plan for dental appointments. So as a result, we should expect the patient traffic numbers to also improve. And of course, we mentioned earlier the new business sale and testing of PCR kits, then I think return profitability and the rest. Next slide. Okay, this is my last slide. There are a lot more details in the report, but this is just a summarized version. Okay, in terms of valuation, getting a target price is not easy. It's not a straight cut because there are very little direct comparables, number one. And you can see from the table on the left, the coverage of healthcare stocks in Singapore is quite sporadic, and also the valuations are quite wide. So the big ones like IHH and Raffles, they're trading about 40 times PE. Then we have a Topman and so forth, SMG and QNM. And then on the table on the right is what has been their normalized PE. Why we use normalized is because there have been a lot of one-off gains. So we strip that out to have an approximate of what has been their PE. So when we converge the two, it seems that the industry is trading about 40 times PE. Of course, these are hospitals, so there are different leagues. So we're taking like a 50% discount. And historically, they trade about 26 to 40. I don't think we're going to benchmark anything to 40 times PE. So again, there's no magic to this. So we're just taking like a discount to this. That's why we arrive about 20 times PE for FY21 earnings to get to our target price of 70 cents. So we're initiating buy with a target price of 70 cents based on 20 times PE FY21. There are more details in the report, so this is just a summary. Okay. Next, I think we'll discuss on the results. Okay, so we'll move on to Micro Mechanics results. They released their second quarter 2-1. So from the title, outlook is healthy. I think the outlook, for the first time, I think the management said they're looking at a super cycle. But for us, we just, near term, I think the valuations just look stretched for us. So we downgrade to neutral. Next slide. Okay, if you look at the summary of the results, the PATMI is up 34, but this is in line with our numbers. I think for the full year, we're looking about 40 plus jump in earnings. I guess the more important one would be probably the bottom one, dividend per share. So they actually raised their dividend 20% year on year. As the note suggests, this is the second year that they're raising. And over the 2 years, they actually raised their dividends 50%. So if we go to the results, in terms of the positive was the revenue is another record high. And I think a lot of it came from China and also from the US. So basically, there are two main drivers for them in terms of growth. The first is the overall pickup in semiconductor demand. So I think you can see that in the China numbers. The second reason is that the US sales also jumped. You can see that 18% is because they highlighted before, and we mentioned before, that they have a new front-end customer. They have not announced the name, but they just say that it's parts for gas handling in vacuum chamber. So these are maybe likely the CVD and PVD kind of disposition machines. Okay, in terms of the outlook, there are two things we just wanted to highlight. Firstly is the high barriers to entry. So just to refresh, I think not many will actually understand what they do. So what they do is, if you look at the, so bear with me for the next 1 minute. I mean, there's a wafer fab that is produced by Chartered or even TSMC. So there could be hundreds of or thousands of those little dies on the round wafer fab. So what they do is they are consumables that will help pick these dies and kind of package it. So they are for example, their core product is this thing called the rubber tip. So if you look at the outlook again, so we think the high barriers will persist or even go higher, because for them, these rubber tips are customized proprietary materials, and they can be a lot of, because these are so fragile and where you cannot have any contamination and also any reaction to the wafer die. I won't go too much details, but anyway, we just think that the barriers will continue to rise, and that is positive for the outlook. The second thing is the ongoing surge in semiconductor demand. I think we all know this from data centers and all that. So we did ask the management, because they actually put in their results note that there's a super cycle of growth underway, and we just asked them if this was backed by customers' orders, and what they just said was customers are telling them to prepare for a ramp. I mean, that's all they could say. So this super cycle comment is actually backed by on the ground demand. But nevertheless, we did downgrade to neutral, because again, we always benchmark it to their peer semiconductor equipment, which is already 21 times PE. So that's how we downgrade to neutral. But nevertheless, the merits for this is still there. They're still paying a 4% yield, the high ROEs, and also a net cash balance sheet. But just that for valuation purpose, we downgrade it to neutral. Next slide. Okay, last result for me will be UG Healthcare. Is a bit strange when we talk first half results, but a blockbuster quarter, because the first quarter usually they only give an update, but it was another very strong quarter for them. Next slide. So if you look at the table at the bottom, you can see that the reason why we say blockbuster is that they actually did a quarter-on-quarter growth. So the PATMI at the bottom table jumped 42% quarter-on-quarter, to 32 million. Then if you go back to the top, because we are discussing first half results, so if you look at the table, revenue triple, PATMI, I'm not sure how you're going to count this. I actually had to try and count it myself about 64 times. But anyway, in terms of the positives, it was mainly the selling price. Volume jumped 20%, and then the selling price 1.5 times. So as a result, gross margins also surged. Then the third bullet point, their operation doing so well, so they jump from net debt to net cash, to a net cash balance sheet. It's like a 360 swing, minus 37 to plus 32. So it's a big surge in cash. Okay, the one negative that they did highlight was there has been some shipment delay. So in a way, they couldn't lock in all the sales in this quarter because some were delayed as they were shipping to Europe. And also they mentioned the shipping rates to Europe actually jumped 5 times. It used to be at 1,000 to 2,000 US per container, now jumped to 10,000. We did an estimate of how that impact on the cost, but even with the jump in shipping rates, because the prices spiked up, right? So it's only 2% of selling price. So the impact isn't that material for them. In terms of outlook, I think we still see quarter-on-quarter growth because selling prices for gloves are still rising. Again, we think that, for us, we are targeting on 2020 valuations because 2021 is a blowout year. So we're all looking into a more sustainable 2022. So what will happen for us is that 2022 will be supported by a 35% jump in capacity. And also, the unique thing about them is they are exposed more to emerging markets, to China, Brazil. So, and the penetration is low, and they got strong into these markets for many years. So, in emerging markets jump faster than the rest of the market, then the rest of the industry, then they should benefit. We are maintaining a buy, but we downgraded our valuations target price to 103 because the whole industry, I think the last 3 months since our report the valuations have contracted quite significantly. So as a result, we're just benchmarking it back to where the industry is. Next slide. So very quickly, let's go through our usual Singapore Weekly. Next slide. Okay, in terms of macro numbers, I guess the big one was the retail sales. It's still retail, still weak. I think consumer spending still sluggish in Singapore. But supermarket sales was just still amazing. I mean, it's still up 25%, even faster than November. So whatever slowdown we thought supermarket was going to happen, it ain't happening anyway. We did a quick check on Google Mobility whenever the retail sales is out, just to see how is activity levels. Apart from supermarket, most things are still below, still like flattish. We'll show you a chart later. We had a PMI just to tell you basically that manufacturing activity in Singapore is still very robust. It's like highest in almost 2 years. In terms of US news, the key one is I think the 1.9 trillion stimulus is going to go, will happen under this budget reconciliatory process where you just need a majority, you don't need the 60 votes in the Senate. And I think Biden, just to remind everyone, Biden just said that the biggest risk of fiscal policy is not that it's too big, but it's big, just that his worry is too small. So that's why he has to go big in terms of stimulus. There was a job reports, and it's actually quite big because most of the job gains actually came from temp jobs. And since the US, I mean, this is just an interesting anecdote. I mean, since the pandemic hit, the US lost almost 10 million jobs. Since the pandemic hit, they are still down 10 million, although there were recovery in jobs, but from that point in time in March, they still are net loss of 10 million jobs. So they're still, the job market is still weak in general. Okay, in terms of our tactical views, I think we see the lockdown, the pandemic, so not easing, and then will be supercharged by fiscal stimulus and pent-up demand. So we think we're still positive on the market. I think there will be a huge surge in the economic growth for all these reasons. Okay, just one last point. We have a slide later, but on Thai Beverage, because they came out with I think like 100-page plus report on their impending beer co-listing, where they will spin off Chang Beer and Sabeco. In terms of the impact on Thai Bev, they've not stated what kind of PEs they're looking, but if we just take 30 times PE, roughly in industry PE, I'm not sure who's going to pay 30 times, but that's the industry valuations. The interest savings you get from Thai Bev is about maybe 3.5, so it's not that material. In terms of weeks ahead, now we got the DBS results. I guess the key one is on 10th of February. These are all the events that's coming up. So on Wednesday, next 1-2 days, we will have a UG Healthcare 1 p.m. So if you have time, feel free to dial in and just ask them questions. And also we have things like PropNext, Credit Bureau all coming up. Not everything is in the poems yet, so you just have to wait for registration. Next slide. Okay, in terms of pandemic, the good news is that the pandemic is continue to taper down. So it's good news that we're contracting fast. So this is good, of course, for the whole global growth. Next slide. Okay, I think this one was just that there was this Straits Times article that said that the world population will only be inoculated in 7 years. I'm not sure how true that is, but anyway, next slide. Okay, in terms of Singapore, only there were 3 community cases, and there were actually surprisingly 1 dorm. When I read through, most of them were actually kind of related to imported cases in a way. Then Singapore we're going for Moderna vaccine, and I mean, and there was one interesting note that they said that there's 1 reinfection in Singapore. That means someone who had COVID now he got it back again. Next slide. Okay, okay, and just wanted to show you that Sing Song numbers should still be another strong quarter. I think you can see the red bar. Although there was a big spike because of circuit breaker in second quarter, the red bar, but you can see that it's still sustained. Actually, even accelerated in terms year-on-year, in terms of the fourth quarter supermarket sales. Next slide. Mobility. So we just wanted to check, but actually this mobility data we get from Google, basically they just show activity by all the Google users. You can see that actually it's quite good in the sense that it shows that the orange or the yellow bar, that the grocery is above pre-COVID. What is happening is that the retail is still weak. The blue bar, workplace, people are still working from home. You can see that it's higher than circuit breaker, but it's still below the pre-COVID levels. And I don't think anyone's using the MRT if you look at the transit number. And it just show that it's actually quite a good barometer to measure day-by-day activity. Next slide. Okay, in terms of the Thai BEV, this is exactly the same slide we did last week, but what we added was the red box at the bottom. So they announced the vehicle. As you can see, sorry, it's a bit small, but initially we thought the profit would be 167, but they came out at 149 US. So the thing is, under vehicle, we thought that they would remove all the debt which they did, but for vehicle they injected cash. So I think vehicle has even interest income in it. So as a result, I think most of it is because of it depends how much debt they want to put into vehicle. So for vehicle, the debt is small, and then vehicle, as you can see from the second bullet point, is only 200. They had a net cash of 200 million. Whereas if you look at from the Thai beverage accounts, it's sorry, a bit confusing, but Thai beverage, there's a 5 billion debt on this. And then you can see the first bullet point in the Thai beverage accounts, the beer business has an interest expense burden of 174 million, but Beerco is 9.7 million. Actually, it's a positive because they got actually finance income. So it's all about how much debt you want to put into Beerco, then you can get whatever valuation you want. But anyway, in terms of the Thai BEV impact, the third bullet point, if we assume 20% still, blah, 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 then I think there'll be an interest saving about 331 million. So this will help Thai BEV spend me about 3.5. So it's not that significant, and in terms of the impact on the earnings. Okay, next slide. Okay, I know this is just 2 slides on the usual events. The big one again, like we highlighted, is on Wednesday, the DBS results. Next slide. And then there'll be a lot more results. I think you can see that all the banks will be coming up 24th, 25th. Okay, I think this will be my last slide. I think we can go for Q&A. So thanks everyone. If you have any questions and answers, we don't take audio, so sorry if you raise your hands and we don't go to you, but under the Q&A tab, feel free to type in your questions. So thank you.
Hello. Hi, everyone. I'll just take the second question. Yeah. Basically, there's a question on DBS saying that DBS prices have went up today plus 2%. I think when you look at it in comparison to the other 2 banks, movement maybe it's a bit more. DBS will be announcing its full year 2020 financial results before the trading market opens on the 10th of February, which is Wednesday. Kindly advise your target price and TA for this counter. I cover the counter, but I do not know the TA. TA will leave it to Wei Ren. But in terms of target price, currently we are still maintaining a whole price at $22.10. I understand it is like much lower than the current market price. But if you take a look at it, the reason for our target price was because that we are still maintaining that they were having they are going to have high credit costs, and income-wise, they will still be hit by low interest rates. We are expecting net interest margins to actually compress further by single-digit basis points as previously guided. I think for OCBC and DBS, this is what they are expecting, whereas only for UOB, they are expecting their NIM to slightly recover. And for DBS itself, this is also the quarter whereby you will see the consolidation of their Indian bank acquisition. So what we know, just solely from what we know, apart from the price that they paid for the bank itself, the bank is also having an operating loss. So this is something that will hurt their top line. Also, something to take note of, however, something that might be unexpected is that we do know that DBS still has about $1 billion in unrealized gains for their fixed income. If they do realize it, maybe there is something that can boost their income levels in this quarter. But moving forward, I mean, it is a long-term versus short-term versus long-term, because if they liquidate their unrealized gains now, then the returns from the bonds in terms of interest will just not come in the future quarters. So this is something that we are considering, but we will monitor DBS. So you just wait for a report. Yeah, this is all I have to say. Maybe I'll let others take the questions first before maybe Weiren move to take on the TA part for the banks when he does it. Yeah, thank you.
Hello. So I will take the questions on REITs. Across the board, REIT prices have been decreasing last week and this week. Is it a good time to accumulate REITs now, such as Ascendas REIT? Okay, so particularly with Ascendas, we actually do favor this counter quite a lot. Reason being, it is one of the largest REITs with about 200 assets under management. So this actually means that it's very stable in the sense where asset concentration risk is low, as well as tenant concentration risk. So because of their scale, they are able to undertake developments, redevelopments, and they are able to pursue larger scale acquisitions, which, given their low cost of borrowing, they are able to make it accretive in a sense. Yeah. So if you see, recently they have been the kind of AEIs that they have done. Some of them include redeveloping light industrial assets into high spec assets, and taking on some of the acquisitions in Australia where they're acquiring logistic assets that are still under development with high yields of about 6.5%. So all of these added together, and they do a lot of these acquisitions. So when you add it together, it's actually quite meaningful. Yeah, and some of these assets that are that they are securing under development, they actually do come with income guarantees, such that they are purchasing it as completed valuation, and there are secured rental guarantees, meaning to say that if they were to be able to have better leasing and lease these asset out to a higher occupancy rate earlier, and these earlier than maybe the 2-year rental guarantee, there's additional upside for the REIT. So their stability, their ability to pursue redevelopments, development projects as well as large acquisitions. So for these reasons, we like Ascendas, and we think that they are well positioned, and they will be a stable counter. Yeah. And so with respect to the target, to the DPU at this current entry price, distribution yield is about 5%. So we think that's pretty fair for industrial asset. That is, the price has been sold down in the past 2 months. Yeah, but we feel that this is a good counter, and this is a good price to enter for stable dividend yield. Yeah. Okay. Perhaps I'll take another question on. Okay, it's below now. Okay, never mind. I'll pass it on to Yang Zijiang. If Paul wants to take Yang Zijiang.
Yang Zijiang, we don't cover, but like we highlighted, with the improvement in container rates, we do expect away for shipbuilding contracts. They should be getting shipbuilding contracts. I think with container rates, like we mentioned, even in UG, they are up like 5 times. So eventually there'll be a reordering cycle. That's what we are looking at. But again, we don't cover that, but that will be the so-called play on Yang Zijiang. I'll give some time to Jie Hui. There's a lot of Yoma questions. I'll give you some time, Jie Hui, to try and to kind of go through all of them. But I'll just quickly run through one question. Hi Paul, what's the difference between Q&M's PCR test kit as compared to the one from BioLidics? So BioLidics test kit is more antigen. It's more of an antibody test. And whereas Q&M is the PCR test. I mean, everybody says this, something going to use it's like the PCR is the gold standard. I mean, if you want to check whether this person has it or not, you normally, most governments will use, if they can afford it, obviously, they will use the PCR test. Antibody tests sometimes don't show what is the full purpose, because if the person has it, then what are you going to do with the results of the test? Then the antigen is in between. It's like a PCR test, but just of the less potency in a way. How one say it? Yeah. But antigen test, the benefit is like a faster. You can get faster results, so you don't have to wait for one or 2 days. And for all the large events in Singapore, actually they do use antigen test. I hope that helps you. Thanks for the question.
Okay, hi. We have a couple of questions for Yoma. So I'll just go through them one by one. Is now a good time to buy Yoma or to wait for a clearer picture? I understand you have a revised target price, and may I know what's the target for the worst case scenario? The TA portion I'll leave for Weiren to guide. Yeah, so basically right now, if let's say you have yet to enter Yoma, I would think that it's best to actually wait it out for a bit. Especially since right now the situation is actually still kind of unstable, as mentioned earlier. Over the weekend, there was street protest, and then yeah, as in internet connections were like cut off and then like back on again. Yeah. As of now, if let's say you haven't entered into Yoma, it's probably better to wait it out and see. Regarding the regarding the target for the worst case scenario, honestly, we haven't come up with like a target for the worst case scenario yet, because it's very difficult to quantify the impacts of this political situation. After all, it's actually something that we didn't expect. It was an unexpected turn of events, and there wasn't any precedent for it to actually properly quantify like what it would be for the worst case scenario. Yeah. But do not be worried, because we will be looking at this counter closely, and then we will keep you posted on any updates. Yeah. And then we have a few more questions from Kenneth. So first of all, how do you derive a revised target price of 34 cents for Yoma? And will the junta military rule pose a risk to wave money business? Okay, so if you can see from my screen, I think my screen is showing. Yeah, so on the valuation portion on your right hand side, you can see that this is what I derived from the changes that I've made. So basically nothing, how do I put it? Basically, nothing material, as in there are no material changes to the way this is actually valued. But in terms of selling prices, you can see from the land bank, we actually revised down from the prices you can see from the site to yeah, as in we cut the selling prices by about 20+%. Yeah. Then regarding the rest of the segments, it was is more or less either based on valuations from previous transactions, like from Tokyo Century or like SF, or based on last 12 months earnings, which we place a multiple to it. Yeah. For regarding the multiples, for restaurants and Yoma Motors, we use a lower multiple. The guided range for Yoma Motors is, I think, 1 to 1.5. We put a 1 times valuation to it. For restaurants, it's 2 to 2.5. We put a 2 times valuation to it. And then for Wave Money, because it's a growing segment, we had a 13 times valuation from the guided range of, I think, 10 times to 13.5 times. Yeah. So this is how I derive the target price. Oh, and then also when it boils down to the asset segment, we actually have put a 5% discount to asset values to take into account depreciation, to take into account possible currency depreciation from this volatility that's happening for this political instability that is happening in Myanmar, sorry. Yeah. And then on top of that, we actually added a 20% discount to the derived target price that we actually have. Yeah, to derive 34 cents for our share price. And then the second part of the question is, will the junta military rule pose a risk to Wave Money business? Okay, regarding that, I would think that Wave Money's business will still remain intact, but the risks will be, as mentioned earlier, as in the military do have the power to actually control whether or not the citizens have internet connections. Yeah, so this on and off internet connection will probably impact the top line and the bottom line for Wave Money, because Wave Money is largely reliant on internet as an internet connection, because OTC transactions has to be made, and then also digital transactions, as in nothing much to say about that, as in it will definitely impact Yoma's business line, Wave Money's income. Yeah. And then the last portion is Yoma has been consistently in Phillip's top 10 recommendation, and I've been giving a buy call since June. However, the stock has been underperforming, and the upside has been retained. So kindly, I've acquired Yoma when the recommended buy price was 29 cents, and can you please advise whether or not it's too late to cut loss, and what's the target price for the next 6 months? So target price, as I mentioned earlier, is difficult to quantify, but we will keep a very close lookout, and we will release another report should there be any material big change. And for the underperforming portion, okay, so maybe let me go through my initial thesis for Yoma. So basically, Yoma had a pretty bright outlook in terms of growth prospects, because Myanmar is actually one of the fastest growing countries in the world, and then also its business segments are actually considered very fast growing as well. So given that there are actually a lot of developments that was lined up for Yoma, we were optimistic about the growth, and therefore our target price was 46 cents. But as mentioned earlier, this whole event was quite unprecedented, as in very unexpected. So as mentioned, moving forward, we'll keep a close lookout and keep you updated on any further developments. Yeah, this is all from me.
Let's quickly move on to the other questions. What's your view on Oceanus? We don't cover. If you recall, we did have them in one of our webinar recently. I think 1-2 months, and most of their profits right now comes from consumer distribution business into China. Unless one believes there's other developments, that seems to be the main revenue generator right now. So we don't have much to update. Maybe 1-2 months time we'll try and get that back in again, and then you can see for yourselves in that sense. Okay, before we run through all the the TAs. Can we just take some of the questions? Why Capital Land drop? Then this one, for the listing of Thai Bev's unit, what's the material or value benefits for small shareholders? Okay, for the listing of this unit, they call it Beer Co, where they're going to list all the beer business. The only positive, that's why we mentioned, is they will just de-gear a bit. As you know, Thai Beverage took up huge debt. Like we show you, almost 5 billion just to purchase this and Sabeco. And then this will be part of the de-gearing exercise. I don't think there'll be any special dividend. It will be just help to reduce their huge interest expense. So the benefit for me is quite marginal in that sense. Yeah, and I'm already assuming like 30 times PE to get a 3% benefit. So if the PE they get is even lower, then I think the benefit will be even less. Because if you look at the Beer Co numbers, there was a growth in the Beer Co numbers. I mean, that is because they actually cut a lot of distribution expenses. I think the top line didn't grow, actually fell. So again, I'm not sure who's going to market this thing, but 30 times will be quite challenging in that sense. Natalie, can you take some of the questions?
Sorry, hello. Okay, I'll take the question on Manulife. Okay. So thank you, Abby, for the question. Hi Nat, in the financial statements released this morning by Manulife REIT, there is a $51.2 million US loss. $51.2 US loss under the item net fair value change in investment properties. The management mentioned that net fair value change in investment properties has no impact on distributable income to the unit holders, and yet DPU was reduced. Could you help me understand what this means, and if you're still optimistic on the REIT going forward? Okay, so yes, you're right. There was 51.2 million impairment to the investment properties. So this was for the second half. On a full year basis, the impairment to the investment properties was about 128 million US dollars. So what this investment property means is actually it's just the assets that they hold, all their properties, the office buildings like Phillip's, Center Point, etc., all the office buildings. So Manulife actually does conduct a valuation. So this year they did it twice, once in June, once at the end of the year, which was December. Okay, so from the end of FY19 to June, the valuations actually fell by about 2.5%, and then from the mid-year to the end of the year, it fell by another 2.5%. So all in, the portfolio valuation actually fell by 4.9% to be exact. Yeah. So one of the reasons, so what affects this portfolio valuation? I think I mentioned this before, but let me just briefly go through. There are three items which will, or rather, valuation. The valuers will actually take into consideration three types of valuation methods. First of all is a discounted cash flow, which is based on the projected income, meaning the rents and the car park income, etc. And they will discount that using a discount rate to the present value. So they will get one valuation through this method. The second method is, of course, comparable sales. If there are any buildings, comparable assets that have been put on the market, so that will be a barometer for how this similar asset class should trade. Third of all would be the capitalization methods. So they will actually estimate a capitalization rate for this asset, which is more of a long-term rate that this asset should trade at. Should be transacted at. So for this changes in property values, yes, it is actually a non-cash item because there was actually no sale, and so Manulife did not recognize any losses, but it's just a paper loss. And as the property cycle goes, there are times where property values will go up, and then unless you sell the asset, you will not be able to realize a gain. Similarly, now in a weaker properties market, the valuation has gone down, but it has not yet been realized unless it is sold. Okay, so why did DPU go down? DPU went down for several reasons. First of all, of course, is lower occupancy in some of the assets. That has led to lower NPI. Yes, and then there was also some $3 million in provision for losses, meaning I think they impaired some of their receivables. However, the latest update, I can just we just had a call just now, and so the management did update and say that half of these credit losses was actually attributed to one tenant, and they have been negotiating the payment terms, and the tenant has agreed to repay the arrears. So I think they will be reversing half of these credit losses. Yeah. So another reason for this lower earnings was because of lower car park income. The management shared that there's car park income actually contributes about 7% of revenue. Yeah, and so because of the lower occupancies, physical occupancies in the offices, meaning that less people have come back to the office, due to the lockdowns in various states, that has a knock-on effect which means that there are just less cars that are parking in the office building, etc. And also because of the car park also does service surrounding buildings, commercial buildings. If there are less people going to the gyms, etc. Nearby, there will be less car park revenue. So revenue was hit on three fronts: lower occupancy, car park revenue, as well as some provision for impairment of receivables. Yeah, so that of course led to lower DPU for the year, despite having a contribution, despite higher revenue from contribution of one of the newly acquired asset, which was Centrepoint. So I hope that answers your question. Oh, sorry, am I still optimistic on the REIT? So from the way the market rents are looking right now, it's still possible that Manulife will be able to have flat to positive rental reversions, and that's it. Some of the rents that have expired. I think if you look at the results, one of the assets actually had a negative rental reversion of about 20%. So, in the double teens. So, although that was negative, in a sense, the reason for this negative reversion was that because Manulife has a rental step up of about 1 to 3% within their leases, the actual lease, which has been in place for several years, has been escalating at 2%. So it means that over a period of time, this tenant has actually been paying above market rents, which is of course a positive. So on expiry of the lease, the new rental rates that were locked in were marked to market, and therefore it was lower. So in a sense, the way that the leases are standing right now in the portfolio, some of them are at market or below market. So there's still a cushion, or rather, lesser impact to MPI from reversions or from signing lower rents. Yeah, so overall, still quite positive on this investment, on this REIT. Additionally, I think the Manulife has also shared that they'll be open to looking at other asset classes that have higher yields, such as business park assets, so as to tap on the growth of technology companies, your biomedical companies. Yeah, and that will be another avenue of growth for Manulife. And they also, I think, evaluating relatively sizable portfolios, which they believe that currently, after having been listed for a few years and the stability of their portfolio, they are able to, or willing and able to, grow in a more meaningful way. Yeah. So that's for me, for Manulife. Let me see if there's anything else. Okay, I think there's a secondary question here on recent results. So I think I also talked about that. The attendee also says that share price looks quite weak, and NAV dropped from 79 to 70 from a year ago. Yes, actually compared to Manulife's comparable peers like Prime as well as Keppel Pacific Oak, Manulife's share price is still down by about 31% versus Prime's negative 20%, and Corp and Keppel's Keppel's already trading at pre-COVID prices. So I think there's a lot of apprehension with regard to the impact of downsizing or remote working. So I think as the economy recovers, as the vaccines roll out, the outlook is slightly more positive for Manulife. And also I think one very encouraging piece of metric that the REIT has shared with us is that the percentage of subleasing that is happening at their building. So while the office market in the US has experienced higher subletting, which means that the original tenant is now trying to lease out their own space that they have rented to the secondary rental market. And in that sense, that will actually increase the amount of space that is vacant in a sense, and it will compete with the vacancy that is already in the building. So while on a whole, the office market in the US has experienced a higher percentage of subleasing. An encouraging metric for Manulife is that the subleasing in their asset actually fell by about 29%. So currently about 4% of their asset has been subleased. Yeah, so yeah, that's about it from me from Manulife.
Can you do the IFAS and the rest of the technicals?
Okay, thank you.
Yeah, there was one, as you're preparing, there's one question on IFAS. There was just earlier 10 o'clock, there was a briefing by IFAS. Let me try and get the question. What is your view on, sorry, give me one question. Okay, and your IFAS, okay, well, with the shoot up of IFAS share price, is there a good opportunity to buy for its IFAS for its stake, for SPH for its stake in IFAS? I'm not. I've got to get back to you on that. I think we tried to address it before. I need to get back to the numbers for you. I think the next call we can do it. But SPH even you don't have to mark to even without that also IFAS is SPH is really trading at 50%. 50% discount to NAV, and some of these assets will not. And SPH has a data center to be built, some bungalows that are not even marked to market. So there's a lot of hidden assets in SPH. But do note that IFAS PE now is about 85 times. Yeah, I mean, over to you, Ray.
Okay, thanks, Paul. So I have a few questions. So I'll do IFAS and then I'll move on to EBS and then Yoma, because I think it was linked to question to Jiehui's one and Hui Guang. So very quickly I go through on IFAS. So you can see my screen, right? If you can't just raise our hand. If you can raise our hand, I mean if you can. All right, so I'll go on. So IFAS has already complete the 5-wave movement, the sub-wave. So you look at the longer chart, I think this is the 5th wave of the larger wave count. I think should be on the primary phase already. So on the sub-wave count, you can see that there's a last week, I think on Wednesday, there was a very large bearish engulfing candle accompanied by volume. So this volume doesn't mean that is increase or selling low. It's just basically that there's the buying volume has really significantly decreased compared as of yesterday. So I can see that although there's a buying back, but price still failed to close above 50%, and then 50%, and then subsequently 61.8% of the whole bearish engulfing candle. So in this aspect, I would say that IFAS will continue to have a correction, or the best neutral stance is IFAS will going to be ranging between 5.97 to $6.50. Okay, I think in the longer run, IFAS will find its rebound at $4.95 to $5.30, or in between the gap at $5.50. So that's the best guess I have for IFAS. So also another scenario is look out for this region. If there is any like pennant, triangle, or sub-pattern going forward. All right, so it really depends on what's the future movement. But I will say that it will be going up more on the on the correction down to 499 to 530. Okay, so the next one is I will do on Yoma first. Okay, so Yoma, as I look at it, I think when prices was last year June, yeah, shoot up to 0.32 to 0.33 resistance zone. But after that, there seems to be a selling, and then it broke off the primary uptrend line, and then it went to a range. Okay, so on the larger on the larger scale, okay, although price has been making lower lows, is very on a very strong downtrend, and you can see that it look like a wedge formation, a larger wedge. So in the longer run, I think you zoom out the weekly chart, I think we'll be looking for a strong rebound to the upside. I think 0.4, and then after that 0.6, and then so on until $0.1. But that is very long, and then I don't know how long it will take from a technical perspective. But look at the immediate term. Okay, Yoma, I think Yoma has a strong break gap. I think due to the junta news, the negative news. But you can see that the momentum has been slowing down. The selling has been slowing down. So I'll attribute this as not the short selling. I'll attribute that people are exiting, much of the price are exiting the Yoma. And price is going to look for the comfort rebound zone between 0.156 to 0.165 for a potential rebound. But however, I think that this rebound won't be very strong. You'll have a false breakout back to the low, and then 0.141 will be the much better price to accumulate it. So both levels will look at it, 0.141 and then 0.165. Okay. So move on to DBS. DBS, I think since I think a few webinars ago, I think mentioned that when the price was here, says that this potentially was a rebound zone. Yes, it did rebound strongly as of today. However, price still need to break above the $26 support term resistance level. By breaking this, we'll resume the upside and test the former resistance zone at $26 to $37.62. All right, so this resistance zone must be break within this week. Okay, so a failure break will result in further downside. All right, so look out for the result. I think Weapon can comment on that, but do look out for this resistance zone as well. All right. Okay, so the next one is Yang Zijiang, and then some power. I'll go on MedTech first. Okay, so MedTech, right? There's a resistance zone that I've been eyeing it. Although it break out the falling wedge already, but price do seem that the momentum when it breaks out, it seems to be a very low momentum. It's much more corrective to a larger bearish sell down. So price has already formed a rounding top over here, and then corrective flag, and then much of a full body bullish bearish candles. So I think that price is going to look for another rebound at 0.89 to 0.83 region before a rebound to the upside. So I would say that now is not a very good time to accumulate for MedTech. Okay, and then if there's a successful rebound and then break the resistance zone one, which highly I think it will, because if you draw out this whole sort of resistance zone is this upside resistance zone has been tested by multiple times. Like you can place 1, 2, 3, and 4, and then 5. So the 6th time, it most likely will have a higher probability break upon the rebound over here. But the next one is 1.48 to 1.56 is the next resistance zone 2 that we will be looking at. Will be a target. So overall, I think MedTech is going on for a strong correction formation. All right. Then from the next one, Yang Zijiang. Yang Zijiang, not much comments. It fails to reach my resistance zone, and then price came crashing down again. So I'll think that likely rebound will be 0.945 again. But I think Yang Zijiang is going to go on for a very strong double set of 333 corrective wave count, sub-corrective wave count. So Yang Zijiang ready, I will stay away from it for now. All right, so next one is Some Power. Some Power, I think Some Power has been going very strong on the upside. It hit my $1 target based on the report last year. Second target, I mean. But if you look at it, it's forming a potential three-way corrective wave. So the next rebound is either at 0.880 cents or 76 cents for potential rebound. Definitely further correction is being evident. First of all, you can see that this evening star is it has closed below the baseline of the Ichimoku. Okay, and then secondly, I think if this bearish engulfing candle maintains it, okay, all the way until market close, then I think tomorrow we'll see further correction. So I can see that volume has been on the decline. So there isn't any much buying going on. So I think the next buying will be either at 0.8 or 0.76. Okay. So the next one is Jiutian. Jiutian, nothing much. I think potentially there's a double top, and then the rebound is very I'll say is a weak momentum. I think next one is the next resistance is going to take at 116 to 112. Okay, so even there's upside, do look out for this resistance between this level. Okay, so the next one is China Aviation. Okay, China Aviation, there's a rolling top, and then if you factor in head and shoulder, there is left shoulder has much of a higher volume than right shoulder. So this is like a potentially, quote unquote, potentially a strong head and shoulder going forward. So bearish candle has been seeing, and then today it just closed below the baseline, the 9-period baseline of the Ichimoku. The both span A and B is flat, so it is showing that price will effectively there's not much demand going forward. And then if you zoom out, this is like a rising wedge pattern. So it is A, B, C. So it's like what the report I mentioned on, I think, Capital Integrated Trust. The structure is almost the same. Overall, it's still on the downtrend. So I think that this is a bearish continuation pattern for the rising wedge is a bearish continuation pattern going forward. So look at A, B, C, and then D wave should be likely here, and then E wave, and then it goes up all the way down. If there's no much demand. All right. So next one I'll go through the last one. I'll go through Ascendas REIT, and then before we end off our webinar for the day. So Ascendas has been very strong. I think Ascendas, since it's breaking of the inverted head and shoulder, like last week I mentioned, if it stays above 3.05, we can see that price is on the verge of going up. On the verge of it's safe to say that we still maintain our bullish stance. Let me close off the moving average. So prices is still on the high side. I think the Kumo twist of the Ichimoku actually indicate that price has resumed on the bullish trend. So I would say that among all the REITs, I think from a technical perspective, Ascendas is much more of a better prospect going forward. All right. So with that, I end off my technical section. But due to time constraint, I think I can't carry on because I got one more webinar at 1 p.m. Any question, just drop us to our stock BNB or community page, and then we will reply you from there on. All right. So thank you for attending. So Paul, do you have anything to add before we close off?
Nothing. I just had a double check. So in SPH books, IFAS is about 250 million, but no SPH assets is about 8 billion. So it's a nice number to have, but I don't think it won't move the needle that significantly. Yeah. But anyway, thanks everyone for listening in. And we'll see you next week on Monday, and I wish everyone a happy Chinese New Year and take care. Bye-bye. Thanks, everyone.